Today we're in Brussels and I just attended the Pyth side event, and now I have the pleasure to talk to Marc, who is the director of Pyth Data Association. Thank you so much for dedicating time to have this conversation with me.
Thanks a lot for taking the time. Always happy to talk Pyth related things.
Yeah, and while I was upstairs, I had a chat with one of your colleagues about the name, and it's a really interesting story. Could you tell me more about it and how did you come up with the idea?
Definitely. So Pyth.Network, I mean, many people usually assume it comes from Python, the coding language. While we have a few Python like integration guide, etc., to consume the data, name comes from ancient Greece, the Pythia. So the Pythia was at the Temple of Delphi. It was the priestess of Apollo, and pretty much her job was to give the God's truth to us mere mortals. And I mean, if you saw the movie 300, before going to war, they go to the Oracle and pretty much ask like, are we going to win? Should we do it? Etc. So very much it's Oracle back then. Mythology is the bridge between the God's truth and the human that don't know anything. So Pythia went for Pyth, and that's why, I mean, you go on our website, you'll see it's very Greek themed, and it's this, like the whole idea is, and for financial data, pretty much give the true price for financial assets to, in this case, not mere mortals, but specifically for DeFi apps.
Yeah, to be honest with you, when I look at the name, I also thought it comes from the coding language. But thank you so much for clarifying that for me and our listeners. And as you said, so it's one of the oracles out there, and you're trying to focus on high fidelity financial markets, and you're aiming to bridge the gap between the financial markets and the DeFi. So could you tell me a bit more about the services that you provide? I know that one of them is the price feeds, the other one is the benchmarks, and the entropy. So could you run me through all these three, please?
Definitely. So first, I think benchmarks, we can package it into price feeds. So price feeds, it's like any DeFi app that like a ball lending, a perp protocol, they need to know what's the price of an asset. So you can borrow like the correct amount, or if they have to liquidate your position. So the price feeds part, whether like, let's call it the live prices and benchmarks, is all about enabling this DeFi. So when we say price feeds, it's going to be the live consumption of data. So you have like a public endpoint, and you can get private endpoint where you can just pretty much, like a traditional off-chain API, you hook yourself onto it and you receive for free off-chain all these price updates. And whenever you need, you can send this price update on chain to consume it. Benchmarks, it's pretty much the end usage is the same, but benchmarks enable to fetch any historical data in the past. So for example, option protocol, they have to settle their weekly options every Friday at 8 AM sharp. And rather than just listen to this off-chain endpoint continuously and have a trigger at 8 AM, they use benchmark, where they pretty much ping a database that stores all these piece prices that were ever created, and are able to ask, okay, what was the price of Bitcoin at 8 AM sharp? Send this information to me on chain. So it's like pretty much the same product, or comes from the same prices, some price feeds, but it's a different way to consume them. So options are using those. A few perpetual protocol use those. For example, Synthetix use this. They have a delayed settlement mechanism. So saying, instead of listening to off-chain directly, I'm going to click long or short on the UI. The UI is going to record the timestamp at which I did my action. 1 second later, they're going to ping the database and be like, okay, what was the price at this exact time so I can fill my user trade at this price. So this is price feeds and benchmark. And this has been live overall since end of 2022. And now available on 60 chains. Like all the chains that are supported by Pyth have this ability to use the live prices and the benchmarks for like 500 price feeds. Entropy.
I'm sorry to interrupt you. Before we move to entropy, yeah. Whenever we talk about benchmarks, I always think and know that they have to be decentralized. And one of the reasons is the Libor scandal that happened in the UK, where banks colluded and they were feeding a number that will benefit them. So could you just elaborate on this and tell me a bit more, why do we need this prices and benchmarks to be decentralized and provided by multiple parties?
Yeah, different. And we take Libor example a lot, where it's like actual manipulation of data. How do we prevent it? Or first, even you have two aspects of having wrong data, either willingly or unwillingly. Like you can have a bug, like you can not be malicious, have a bug for whatever reason, and create a wrong price. So how do we not create a wrong price? Having lots of publishers, up to 60 per price feeds, and with an aggregation algorithm that is pretty much detect outliers to then kind of keep the prices accurate. So easy to understand is as long as the majority, so 51% of the publisher are accurate, the price will be accurate. So this is, so I mentioned 60 publishers on Bitcoin, meaning that as long as 31 publishers are pretty much telling you that Bitcoin equals 60K or whatever today's price, you'll get an accurate price. Then, and you make a great point, what if the data is good, but someone corrupts it or send fake data? So this part, we solve it with wormhole. So wormhole, it's most people associate it with like a token bridge, but at its core, it's like a messaging protocol. You can send arbitrary data from any chain. And so wormhole, it has 19 guardians, which are like the biggest like validator of most chains, like Figment, Triton 1, etc. They observe the Pyth app chain where all these prices are created. And at every block, so every 400 milliseconds, all the guardians observe what's the price of Bitcoin and generate proof. They're going to reach consensus. So as long as, or as soon as 13 of the 19 wormhole guardians observe the same thing, it's going to create a proof, a wormhole proof. And then actually users, whether it's of price feeds or benchmarks, they don't update actually a price. They don't send a price on chain. They send this proof into the P smart contract on their chain. And the P smart contract is going to decode the proof, and it's going to verify that it's an official kind of proof price, and decode it and then use. So overall, we leverage wormhole not only for distribution, but also for this security part where, like, if I try to send a fabricated proof, I try to fake that wormhole price and say Bitcoin's at 1 million, the smart contract, the P smart contract is going to detect this and reject what you like, this fake proof. So that's how we avoid the Libor scandal of, even if we have the correct data, we give you a fake data, it's impossible with Pyth.
And it's already encoded in the smart contract, so there is no way you can change it at any point. And it's not to argue that you're malicious in any way, but whenever there is a single point of failure, this is something that we should be concerned about. So the example with wormhole that you were giving me is like, regardless of you stay or you let the Pyth to be governed by its DAO, as that's something they're planning to do at a later stage, that won't be able, they won't be able to change that. So the data that's provided will always be accurate. Is that correct?
So overall, do you mind rephrasing a bit the question?
Oh yeah, sorry. So I was just wondering whether the example that you were giving me is like, encoded in the smart contract, so that can't be changed.
Okay, so the Pyth DAO, so to be part of the Pyth DAO, you have to stake Pyth token, pretty much. And the Pyth DAO has the power to, it has various powers. It can decide, actually it has all the power over the network. So pretty much, if the DAO decides to destruct the code, if majority wants to destroy, yes. The thing is, people are ends up mostly being rational, especially with value. So imagine you want to attack the Pyth.Network today. You'd have to buy, let's say, 51% of the supply, stake it, and pretty much it's going to cost you hundreds and hundreds of millions. And once you destruct this, it has no value. So just like the economic of the network, pretty much you'd have to be insanely well capitalized to do it. But on a more lighter note, it's DAO can decide anything. So for example, this product, this new protocol, not even product, that was announced today, Express Relay, this was approved by the DAO. So Pyth started with price feeds, but it could technically create any type of new product, any type of new protocol. And we saw it with Entropy. Entropy was also approved by governance. So it's very much the governing body of what this Oracle network is going to do. And for example, we've worked a lot with the Optimism ecosystem, Arbitrum ecosystem, and we've learned a lot on how they do DAO, how they do governance. And so, for example, we have a constitution. There's the Pyth DAO constitution that in it, for example, delegates, states all the powers the DAO has, and some of these powers were actually outsourced to council. So we have today two council, the Pythian Council and the Price Feed Council. So Pythian Council is akin like the security council of other protocols, so it can upgrade smart contracts. And why would you upgrade a smart contract if there is like a new version of the protocol that makes, I don't know, things more efficient? Like this council has the power to upgrade the contract. Fees also can be increased. This is done by the council. And the price feed council is more like a daily operation council. Like all these price feeds, pretty much, they're like all created on chain. And so publishers and transactions. So let's say you're a new publisher, you want to start pricing Bitcoin. The price feed council has the power to enable you to price it. So it's pretty much like governance is a whole, and we've got involved in a lot of governance. It's hard to do everything with voting, token voting, because half the people just don't follow too much. So the idea, the community decided, all right, let's initially have this structure whereby, like almost a republic, you elect people, you delegate power, and then you elect those who will like share the powers. So like overall, like all the future evolution of the Pyth network pretty much will happen first on the forum, public forum, where anyone can come and suggest new idea. Forum is like forum.pyth.network, and we had recently like bunch of proposal, or not yet proposal, discussions around incentivizing staking, for example. Whether it's pure yield from emissions, whether it's a new type of like distributing fees, is it like anything technically. So it's very open-ended, and it's, end of day, DeFi, like our primary customers, or DeFi, not customers actually, users, because it's a permissionless integration. They should care about using a decentralized infra, because they don't want anyone to be able to shut access. And so here, leveraging the DAO, leveraging this like permissionless ness of the network makes it, I think, a great reason for DeFi app to use Pyth.
Yeah, you touched upon so many interesting topics, but the one that I would like to delve a bit deeper in is the token and the functionality of it. I know that the main function is governance, but you also charge the users of your product in the native token?
No. So that's actually some oracles do. The DAO, so today how it works, the fee, so I'm an application on, let's say, Arbitrum. I will request a price update and pretty much do an Arbitrum transaction. I'll send a wormhole proof into the P-Smart contract. And to actually be able to do it, I need to pay a fee to the P-Smart contract on Arbitrum. Till now, it's charged in the native token of the chain. So, for example, on all the EVMs, the Pyth oracle, let's say, collects ETH, not Pyth. Again, here, it's many oracle. Usually they say, oh, if you pay in my native token, I don't know, I'll give you a discount of 10%. This is technically possible. It will have to be decided and approved by the DAO. Personally, I don't think it's, I mean, many community members have asked, I don't think it's that powerful because Pyth token is a Solana SPR token. And like we're on 60 different, or the product is on 60 different chains. And it's not that easy to bridge a Solana token to an L2, especially like a Bitcoin layer 2 or things like this. So it would, I mean, the impact wouldn't be that big. And I think it's almost great to, at least initially, collect other things than your native token. Because we see a lot, you know, those, oh, this DAO has $1 billion in treasury, but then it's $1 billion of their own token. And we see bear market, etc. Like usually it goes 90% down. And while things like ETH, let's say, have had less drawdown. So it's, I think, also a great way to diversify the DAO treasury, or yeah. So not yet. It can be done if approved by the DAO. And actually on the Cosmos chain, I think the functionality is natively available. You can actually pay fees in any token, and pretty much they'll do the swap for you. But yeah, so at some point you might have the ability to pay the fee with Pyth, but then it can be clunky. Like another example of why it could, let's say, be hard to implement or for apps is as you do a price update, the application can do it itself, but you can actually also have your user, without him knowing, do the Oracle update. So as you want to trade, your protocol is going to bundle the Oracle update and your trade in the same transaction. And so in this case, the user is actually bearing the costs of the Oracle update. And imagine we were charging Pyth. If you don't have Pyth in your wallet, it would fail. And most oftentimes, like, very little amount of users know what Oracle, like the perp, is using. So you almost be like, oh, I'm trying trading here, and I'm getting rejected every time. And then, oh, I need Pyth. Okay, I'm on Arbitrum, I'm here. I need to go on Solana, then bridge. So it can be clunky, but it's definitely doable.
Okay, so the only function for the token is the governance function. Is that correct? So they can only vote with that when people have it.
As of today, you need to stake on Solana, and yeah, you'll be able to vote on, I mean, any proposal put forward. Anyone can put a proposal forward on chain, but again, after the DAO, the community is able to propose new utility to the token. And one discussion happening on the forum right now, so it's forum.Pyth.Network, is around actually bringing some utility, is around, if it passes of course, asking publishers to stake token that would tentatively be used if the Oracle fails. If the Oracle were to produce a wrong price, you could slash publishers to reimburse the affected parties. So this is being currently discussed. I think this is super cool idea. More so on the user side, I think it would help Pyth grow a lot, because I don't think any other Oracle has this kind of insurance mechanism. So like there will be more utility, I guess, because people love utility. They can suggest utility. So if you have some ideas, go on the forum. But yeah.
Okay, so just to bring you back to the network, it brings the data from over 108 first-party data providers, and you include some of the biggest exchanges. How do you determine the rewards for the data providers? But also, could you tell me a bit more about the evaluation process? How do you determine who would be a reliable and a good source of information?
So I'll first answer the later part. So how, before a publisher, let's say you're a new publisher, you want to start pricing Bitcoin or etc. The first kind of requirement is you should own the data you're going to contribute. Mostly because, I mean, for accuracy, because many product reason, but also legal reason. Like you shouldn't be selling, let's say, things you don't own. Then, let's say, your first-party data, you own, you create the data, you own it, you want to contribute it. Everything, like all publishers have like what we call conformance testing, whereby for 3 days, for a week, for however long needed, pretty much they'll be on the testnet version of the network, and they'll be compared continuously versus the existing publishers on mainnet. And whenever, let's say, results are good, etc., they are able to go from testnet to mainnet. So there is a strong like reliability and conformance testing done on all the publishers. And so this is done, for example, by the Price Feed Council. The Price Feed Council is in charge of, say, onboarding, approving new publisher, and potentially removing publishers. You've been sending bad data, even not maliciously, but your data has been poor quality, we can remove you, for example. So that's for the second part of the question. What was the first part of the question?
So the first part of the question was around the rewards.
Oh, yes. So as of today, there is most of the rewards are going to come from. So we have part of the tokenomics. I'm going to be wrong on the number. Either 22 or 25% of the total allocation that are, let's say, assigned for publisher rewards. So this is, it's kind of the bootstrapping initial rewards, because, for example, today, like the network hasn't increased the fees a lot. So it's kind of, we're in the phase whereby the idea is to start that like exponential growth, do, I don't know, 100 million updates a day, then on increase the fees, because currently they are the smallest denomination possible, so it's pretty much dust. But what if it becomes 1 cent? And then you have all these rewards, these fees getting accrued in those P smart contracts on all these blockchain, and pretty much it will be DAO owned. And until now, the DAO hasn't decided how to allocate those rewards. Why? I mean, as mentioned, being charged one way, it's not sustainable amount of money. So, and for now, the publisher reward part, I mean, token help a lot until, let's say, the market, this data marketplace is self-sustainable. The whole goal is like have these users use the product, pay fees to it, and then from the DAO perspective, I think like publishers are the fuel of the network. Like without publishers, like there is no price feeds, there is nothing. So I think it's going to be very important to heavily reward publisher from fees. Like, I don't know, 75% of the fees should be allocated to publishers. And the DAO could keep 25% for, I don't know, increasing the treasury, etc. So it's rewards. I mean, publishers are also like many are trading either on chain or investing throughout the ecosystem, and for them it makes great sense to like better infra means better apps. So it's also kind of for them putting aside the financial rewards or directly from the Pyth network, it kind of further help all the other endeavor. whether they trade on chain, whether they invest like more like venture capital way. So it's also kind of let's grow, let's make the eco better. That push a lot of publishers to do things.
Yeah, so you are right on the 22% being reserved for the data providers. I know the number because I noted it down while I was prepping for the interview. So the way that I'm understanding it is that you have 107 data providers and they provide all this data, and the protocol aggregates the data and put a single aggregated price every 400 milliseconds. So could you just run me through the mechanics behind it, and how do you collect the data, analyze it, and do it?
So overall, so one thing to mention 100 publishers overall. The idea is not all publishers publish for all the assets and price feeds the Pyth.Network supports. So for example, if we take Binance is a Pyth publisher, Binance is technically only able to price or to contribute data for assets they have market. So for example, many of the staked Solana tokens, MSOL, BSOL, you name it, they don't have markets on Binance. And so Binance cannot and doesn't provide data for these specific price feeds. Instead, we have DEXs like Orca Radium, which are the two main trading venues for these Solana, like liquid stake Solana. They are contributing for like these specific feeds. And for example, like they don't provide data for Bitcoin because it would be a wrapped version on Solana, so it's not very much Bitcoin. So it's, I mean, I think the feeds with the most publisher must be Bitcoin with around 60. And this comes from, for example, Binance, Bybit, but also more the trading firms that are trading on all these exchanges. In how tech-wise it works, so overall, so Pyth, the price feeds are created on what we're going to call Pyth.Net. So it's an app chain that fork of Solana. It's a proof of staked authority chain. So pretty much all the publisher are kind of validator of this blockchain. It's a permission blockchain, meaning that only publishers are able to send transaction, interact with this blockchain. So it's kind of almost your, like, if a Web2 company would create a chain, it would, I mean, here it would be 100 Web2 company, each being kind of a validator, let's say. So it's kind of a private chain, publicly viewable. So it's because the whole goal is to have this transparency, this like verifiability of if someone sends a wrong price, we need to be able to verify on chain. And so overall, a publisher is going to send at every block, so every 400 milliseconds. Let's say I'm a publisher and I publish just for Bitcoin. Every 400 milliseconds, I'm going to send a transaction to Pyth.Net saying, like in this transaction, it says Bitcoin equals $55,010. On this app, so all publishers are going to do this every 400 milliseconds. On Pyth.Net, you have a single smart contract, which is the like aggregation contract. And pretty much it will listen to all the inputs of publisher. So can you imagine slot 1, I send my price, Bitcoin equals 55K. At the end of the slot, it will have received, I don't know, about 60 different inputs from 60 different publishers. And at the next slot, so like about every 400 milliseconds, it will aggregate based on this smart contract. And so it's very much, there isn't any intermediary. Like it's very much like the publishers run this network and they directly interact with it. And I mean, this network, I mean, it's a permission network because like there is no need to have DeFi on it. Like the whole idea is to create those prices publicly, verifiably, and then be able to send them on other chains. So I'm a publisher, I send a transaction, next block, the smart contract will have produced the aggregated price. And at the same time, you have Wormhole observing and like reaching consensus, what's the price, and then creating this proof. So it's Like there isn't, when earlier I mentioned the analysis, it's actually everyone could do the analysis. Like if you in your room, you want to like listen to the testnet and just review people's data, you can. But it's very much like there isn't a single entity that, let's say, manage this. It's it's kind of a blockchain directly managing this.
Yeah, thanks for clarifying that for me. And we already had that conversation earlier on, but my initial question was, why do you need your own blockchain? You could have essentially be built on Solana or any other blockchain. Could you elaborate on this and explain the reasoning behind it?
So the Pyth.Network was initially deployed on Solana in 2021, the V1. Which is still running today. It's actually gonna be sunset at the end of this month. So in 3 weeks, where we started will have vanished, and now we're on the V2 with Pythnet. But why Solana initially? It was fast and cheap and scalable, and it worked amazingly well. I'm not gonna say V1 was a proof of concept, but it showed that this was working. Why did Pyth V2 create its own chain, the first, let's say, a big Solana virtual machine based chain, for a couple reasons. While like in 21, 22, Pyth V1 was the leading oracle on Solana, DeFi happens a lot outside of Solana. And actually you have, I think Solana's 4 billion in TVL for a market of 80 billion. So just being on Solana and like isolated from all the other DeFi ecosystem, like wasn't the goal. And so if, let's say, a DeFi app wants to use Pyth price feeds that are created on Solana, what happens when Solana goes down? Like if the Oracle, like if Solana's down, the Oracle would also be down. And for Solana apps, there is little impact because everything's down. So whether the Oracle works or not, you don't care, the blockchain doesn't work right now. So like it was hard to get non-Solana DeFi apps to integrate an Oracle that depends on Solana. Because you had big NFT mints in 2021 or token launches and everyone spamming, and even if the downtime, like even if there is no downtime, but there is degraded performance, it's not great. So from a reliability perspective, it was very important to have like an environment you can control almost. And second is cost-wise. Using a public blockchain, I mean, you need to get the token, so in this case Solana, and publisher, like they're sending every block, so that's a lot of transaction. Back in the high days of like Pyth V1 on Solana, about, I think it was 2/3 of the transaction, excluding the consensus vote, were like related to Pyth.Network, were Pyth publishers sending updated price every block. And so we have a wonderful Dune dashboard in our docs and if you go back in time, there must be a few days where the whole cohort of publisher must have spent in total like 50 or 100 SOL. And this, I mean, 100 SOL when it costs $8, maybe it's fine, means like 1K of cost per day. Technically it's okay. But when Solana is at 200, that's a bit more problematic. Using Pythnet, Pythnet being a blockchain, it has a native token, but it's a purely gas token. Like there is no utility but to make this like Pythnet, this app chain work. So these two reasons, like cost-wise, reliability, were the main driver for Pythnet, or why having your own app chain. And maybe one thing that we haven't done yet, and we might see it soon, is further improving the performance of Pythnet. Till now, it hasn't been much of the focus, and by performance I mean speed, because Solana for the longest time, I mean, arguably today, still today, is one of the one of the quickest chain. So there is no insane rush to go back to, I don't know, 10 millisecond or 40 millisecond speed.
Could you just explain to me, what do you mean by using Pyth as a gas token on your chain? Because
Pyth itself, so the governance token is not used on Pythnet. So there is a second token. It's called PGAS for Pyth.Net gas, pretty much, and it's a token that has zero intrinsic value. It's mintable forever. Like we can, I mean, the network, the DAO can. You have vote where you can mint if you want infinite number of PGAS, and this is just allocated to validators / publishers to make the blockchain work. So it's kind of, I mean, it's your oil. I mean, it's your oil that you put in your car. Like once it's in your car, I mean, you can extract it and resell it maybe, but I mean, I guess not many people do it. But it's kind of closed source system, and it's just to make things work.
Yeah. Okay, I really wanted to talk a bit more about push and pull oracles, because the concept of pull oracles has been gaining popularity. So first of all, could you explain to me what's the difference between push and pull oracles, but also how do you utilize pull oracles on Python?
Yeah, so push oracle,
so Pyth, sorry, I keep calling it Pyth for some reason. I realized it. I was like, oh, I'm so sorry.
Many Americans come with the Pyth.Network. I mean, we don't care so much. I mean, yeah. It sounds kind of better, but it's normally we should say Pyth. But I mean, I don't. As long as you talk about Pyth or Pyth, I'm okay with it.
Yeah, I guess I mixed it up throughout the interview. I call it Pyth and Pyth, so it's just very difficult. But yeah.
Push oracle and pull oracle. So, idea of push oracle is, and I mean the first versions of Oracle, let's say last cycle, for example, and Chainlink, the most known and the most successful so far. Pretty much the design is, I being the oracle, proactively update the prices of assets on chain based on rules. So for example, let's say Ethereum layer 1, the ETH USD price feed of Chainlink has, I don't know, 0.2 parameters, a heartbeat and a price deviation threshold. And the idea is whenever one of these two conditions is met, the Chainlink Oracle is going to push this new price on chain. And so if I'm an app, I can pretty much just sit on my hands and wait for Chainlink to send the new price of ETH in this place on the blockchain, and I can just read it. It worked great for Aave, Compound, those first, like all the DeFi that appeared last cycle, and like today, like biggest one. I mean, perps last cycle on chain were very little or not many traction. So this worked well because borrow lending, and you don't have a lot of leverage, and so for example, having a 1% price deviation is fine. The thing is, so push oracle also means as I push the price on chain, I need to pay the gas fees. And once I push a price update on chain, everyone can read it for free. And one of the constraints of push oracle is, I mean, it costs a fortune to do transaction on Ethereum layer 1. So like imagine you want not only one price feed ETH, but you want 500 price feeds. So now you have to do, I mean, you can optimize bundle price feeds together, etc. But if you start doing like thousands of transactions on the layer 1, I mean, you're going to run an unprofitable business. Then you have, you don't have customizability. So I took the example, it worked well for borrow lending. For perpetual protocol, if you tell a perpetual protocol, actually the price feed you're going to use to fulfill your user trades updates every 0.5%. And what happened last cycle is you had a lot of front running. So I could have my on-chain exchange that use a push oracle updates every 0.5% and have Binance price on the other side. And whenever, let's say the price of whatever asset is 100 on the oracle and on Binance, and like you wait, so like trading happens, keep continuing on Binance, and the price rise to 100.4. And pretty much I can, with good probability, note that the next price update of the oracle on chain is going to be 0.5% higher than the current price. So pretty much people were looking at Binance price, putting a trade because they knew where was, like which direction was going to be the next price update. And so that's why many last cycle, you had very little perpetual protocol like we have today, GMX, Synthetex, like Vertex, whatever. It was very little. Or you had, OG Synthetics, V1, which was using this, and pretty much they had to implement like I think 15-minute window to take on the trade or not. So it was clunky. So that's push Oracle. Pull Oracle is the idea. So first, pull Oracle, it sounds very different, but for me, I almost say now it's a customizable push Oracle. The thing is, you don't rely on the Oracle network to push prices on chain for you. Actually, we enable you to do it yourself. And so this gives lots of scalability benefit. So for example, if you compare push Oracle to push Oracle, they have to pay the gas upfront. So you can check, they all have different catalog of price feeds depending on the chain. Because, for example, layer 2s are much cheaper, so they can have more price feeds, etc. But Pyth, the idea of the pool is once it's deployed, you can actually permissionlessly do a price update yourself and use it. And the hidden benefit for the Oracle is actually, it means that it doesn't spend money on gas. It's up to the application to do it. So it's very cost efficient. So while push Oracle spend millions per year, pull Oracle spends zero, sending the data on the chain. And pull Oracle also enable to collect revenue, collect fees. Because whenever a push Oracle is going to push the price on chain, once it's on chain, anyone can read it for free. And after, at best, you can chase people. Oh, I see you're reading my prices, please pay or please subsidize. Pool, they'll bear the cost of the transaction, but on top of it, especially for Pyth in particular, they have to pay a fee to the smart contract to update on chain. So it's super cost efficient, and actually it has a baked-in revenue generation design. So Pool, maybe I should start saying Pyth is not a pull Oracle, but it's a customized push because it's, you push whenever you want and whatever price fees you want. So it's very customizable. After it, pull Oracle, let's say, have some drawbacks. For example, for Ethereum layer 1. It is insanely expensive to transact on Ethereum layer 1. So let's say, I don't know, transaction spike, and my price update as a protocol, if I have to pay $100 for every price update, I'm going to go bankrupt at some point. And that's why I think Pyth we do see some usage on the layer 1 on Ethereum. Not that many. Most of the usage of Pyth is on faster chain and cheaper chains. So mostly L2, EVM L2s, Aptos, Sui, all these chains. So while there isn't that much traction on Ethereum, the thing is, it becomes like push Oracle. My feeling is it's an unsustainable business because you have these huge costs. You have to chase people to subsidize it, and actually it's just like running a business at a loss. While Pool, at least, it's very lean, very cost efficient, and arguably, if no one is willing to pay the cost to send it on chain, maybe it means that it doesn't have the value, high enough value to do it.
You just mentioned that you don't see a lot of traction on ETH because of the high fees. And I was wondering, how does this compare with Chainlink, because they have a push Oracle? Do you have any data on whether they have a lot of transactions on ETH? Because I guess that's an overarching problem that everyone has with ETH. So whenever I purchase my own ETH, I'll do like at 2 a.m. in the morning, so the fees will be lower.
So I don't have a number, like an exact number, but I would imagine millions of dollar worth are spent purely in gas fees for pushing Chainlink price on Ethereum mainnet. So that means but I think they must have, I don't know, I actually don't know how many feeds they have on layer 1 right now. Let's say they have 50. So most of their feeds on the layer 1 have like 1 hour heartbeat. or like 0.5 or 1% or even higher sometimes price deviation. So like they need to constrain the number of updates with these increased parameters just to avoid spending like hundreds of millions to update price feeds. So I mean, you can do, I mean, I think it must be easily findable on Dune or something to see how much they address, how many transactions they do and how much they spend. But it must be $1 million budget per year.
Nice, thank you for clarifying that. And you announced Express Replay earlier on, and that's a new feature that you added to the Pyth. And I was just wondering, and what you're essentially trying to do is fight EVM. So could MEV, sorry, yeah, MEV. So could you please explain to me what MEV is and how you're fighting it?
Yeah, so MEV usually happens at the validator level. So pretty much the block producer, construct the block, and so usually those user like you and I, we can, let's say, pay more gas fees to be, let's say, higher in the block ordering or be included faster in blocks. Why Oracle start caring more about MEV, and actually we talk also a lot about OEV, Oracle extractable value. Why more and more cares? Because I mean, the competing oracles have also come up recently with their own solution. You can take the example of a ball ending, let's say Aave or Compound or Venus. Every time they need to liquidate, a position becomes unhealthy, anyone can liquidate this position. Who usually end up being liquidating the position? It's the guy who spends the most in gas fee. So pretty much you have it's a 100-meter sprint. You have, okay, I can liquidate a position of 1 ETH, get back some USDC or the reverse. And now it's which one of these 100 different guys that try to make this trade, which one's going to arrive first and collect the price. Thing is, who captures all this excess of gas? Miners. In the protocol itself, the ball ending is actually subsidizing miners rather than liquidators. So most Venus, I think they have like a 10% liquidation rewards, meaning they kind of leak 10% of the position value to incentivize you and I to go liquidate. But the thing is, mention all these rewards, or 90% of these rewards, end up being captured by not us, but the validators. Idea of Express Relay is, let's try to remove the block builder from here. And so that not only the liquidator can actually have, let's say, more revenue, but the whole idea is to actually reduce how much the protocol leaks. So Venus, for example, could say, instead of giving 10% rewards, or they could still how do I phrase this? Or restart. So Express Relay is more like an auction protocol, meaning that nowadays it's not so much a race to who's going to liquidate first, but who's going to pay me more to liquidate this position. So it's almost like Dutch auction almost, whereby you now have Venus wants to liquidate this position. They'll say, look, you start this auction with the classic 10% rewards, but now we compete against one another, bidding, okay, I actually take only 9% of rewards, 8%, 6%, etc. And the highest bidder will be the one that is allowed to liquidate the position. And so that, now I'm Venus, this is from Venus stance, using this auction protocol, using Pyth Express Relay, I can not give away 10% of the position, but only 5%. So it's like saving for the protocol by reducing by optimizing how liquidation works.
Yeah, that makes a lot of sense. And I asked you earlier on because one of my main concerns was how would you keep validators, because a lot of chains are trying to fight MEV, and it's been a massive problem within the entire industry. But validators might be disincentivized to stay on the chain and go to other chains that are a bit slower with dealing with that particular problem. So could you just help me understand? And I know that, to be honest with you, validators already have the fees, so they're incentivized to stay on the chain if you grow, because they'll still get paid. But could you help me understand, why do you think that the percentage of validators that you push away is comparatively small to begin with? And why do you think that the main validators would stay on chain?
You always have MEV, like with these, whether it's with Pyth Express Relay or other like auction protocols specifically for liquidation, like you always have other MEVs, like on Uniswap, etc. So it's more like it's gonna reduce the total MEV. Like MEV is not going to zero. MEV will never disappear, or a long like far in the future, but it's like I don't imagine anyone. I mean, you had validators before there was liquidation on Aave. So I think just the pot is going to become smaller overall, but it's going to be at the benefit of user and the protocol. And I mean, if you have a better product, user will likely use it more, and you'll generate more revenue by maybe classic usage. I'm not very concerned about like, oh, you destroyed the ball ending MEV, I'm gonna stop running my validator. But the second thing is, and I think that's one thing I would love to see happening with Pyth Express Relay at some point, is like those validators could become searchers, they could become liquidators themselves. They already have the infra, and I mean, imagine you have flash loan, they could take flash loan, so they don't even need the capital, take flash loan in like, compete for these, let's say, these savings. So they won't get the classic 9% or 90% of the rewards before, but maybe now they'll just get 3. So I think it's more like and I hope to see at some point some big validators becoming searchers within the Pyth Express Relay. Just, yeah, they know how like the chain works inside out. You have ways to not have tons of capital but still liquidate big position, and I think they have an edge almost versus trading firms, let's say, because they know the infra way better. So I think overall it could help. So I would imagine like no one's going to leave the chain, and I'd rather hope they join the Express Relay Searcher cohort. So yeah, I think looking at the numbers, you have maybe, if all goes well, like all the liquidations are optimized with those anti-OEV solution, it is maybe, I don't know, 100, 200, 300 million of savings, which in the grand scheme of things is like very little towards all the fees generated over time.
Yeah, thank you so much for clarifying that new feature for me. While I was prepping for the interview, I read on one of your blog posts, and I will quote it right now, which is, although it might seem counterintuitive, there is no single true price of an asset. And then you are essentially explaining how every asset has a trading price, but then there is also the price that's generated by the traders. So could you explain that to me a bit more? Because that's a very interesting point that you made, but if I have to be honest, I couldn't fully comprehend it.
So I think best way to comprehend is, if you're on your computer, open Coinbase and Binance, you split your screen in two, you put Bitcoin USD of Coinbase, Bitcoin USD of Binance. And if you look, the price will not be the same. It'll be maybe $1 difference, 10 cents, depending on various factors, like trading fees on the exchange, etc. So like even Bitcoin, which is the most liquid asset within crypto, like you have different price. You have the Binance price, you have the Coinbase price, you have, I mean, all the exchange price, etc. So and I mean, it's very many people like pick this sentence because they're like, oh yeah, actually I didn't think about it this way. So it's like overall prices converge, but so how do we solve this? So the idea is, for example, traders, like let's take the trading firms. I'm gonna trade both on Binance and both on Coinbase. So let's say there is $1 discrepancy in between the two. Likely the true price might sit in the middle. Like you just like do the sum and halve it, and technically you have your mid price. So arguably, while it doesn't trade at this price, technically it's your true price. And so a trader would value the Bitcoin in between those two exchanges. Binance, and especially in the case of the publishing data to Pyth, Binance would publish its price. Coinbase publish its price, so there would be $1 difference, and the trader would likely publish a price in between those two. So this is how, let's say, we think around pricing assets. And another feature we have is, and it's very visually speaking, is on our website, if you open any price feed, like Bitcoin or whatever, the dedicated price feed page, you're going to see a white line that is the aggregate price the Oracle creates, and you're going to see around like bands around the price. We call this the confidence interval. So every piece price, it's actually not just the aggregate price. We have like a plus minus, like we have kind of a potential dispersion. So for example, on chain, when you use piece price, you're going to say Bitcoin 55K plus minus $5. And so this is how we kind of, like, we think the aggregate pretty much says we think this is the true price, but plus minus $5. And maybe on KuCoin, they have like the price is $4 lower, etc. So the idea is more like give a range, ideally the tightest range possible, of where the true price should be. Like, so 55K plus minus 5, so it means like 45, 995 or plus 10. So it's very much be able to capture this, like, this potential discrepancy. In, for example, how could you leverage this confidence interval if you're a DeFi app? If you're a DeFi app, and the board ending example, to be safer, I could decide to, so pretty much Pyth tells me there is like two prices, max price, min price. I could, for example, value your collateral at the minimum so that I'm, let's say, safe, I take less risk. Like I will be sure that if I value at the minimum price, like I'm gonna start, when I start liquidating you, like I'll be sure to have liquidated everything even be like higher than this price. And when you take a loan, like what you're gonna borrow, ideally you take the max price. So overall, you can undervalue slightly your collateral and overvalue your debt. Why would I do that as a protocol? To make it extra safe for my user. Like, and overall the confidence interval at Pyth feeds is like 0.01%. So like you're not getting like a bad deal, but it's, from the protocol perspective, it ensures that I'm not overvaluing your collateral and I'm not undervaluing what you owe to the protocol. So it's mostly to increase like customer funds security, let's say, less risk of having bad debt if I need to liquidate you and market moves fast.
Yeah, that's a really good idea of, how did you call it? Confident
interval. Yeah.
Interval, confidence interval. I'll definitely look into it, and it's like a blind spot for me, but I'd love to learn more about it. So at the beginning of the interview, we were talking about the benchmarks, the price feeds, and I asked you a question about the entropy, but I didn't let you explain it. So could you tell me a bit more about it, what it is to begin with? Because I have a general idea, but I'm sure that you have a better explanation. And how do you utilize it in the service that you provide?
Yeah, so it's arguably the first time the Pyth.Network ventures outside of pure, let's say, financial data or strict DeFi. Entropy is on-chain randomness protocol. So like usually if you're into gaming, NFT minting, or whatever that requires randomness on-chain, you can use Pyth entropy. It was launched in December last year, so it's been out for a few months now. I think it's available on about 10 EVMs. And it works as a commit reveal style, meaning that you have two parties, usually the end user of the randomness. By end user here, I mean let's take the application, like as an application that where you mint NFTs, I'm going to be the user of randomness. I mean, the retail that mints is also indirect or further down the line, but the user here will be the app, let's say. So it's the app and what we call the service provider, and anyone will be able to become a service provider. It's pretty much two people that commit to a number on chain, hash it, and then gets combined. And with this commit reveal design, it's very, let's say, efficient, both in time and cost, because it's a very, say, optimized design whereby it takes pretty much less than a second. I think it's 50 milliseconds to get an answer, and like it costs less than 5 cents. Other existing, I think the most used on-chain randomness protocol today is Chainlink VRF, which is, technically it's the same end product, but it's a completely different design. And VRF, for example, are a bit like slower and more costly because it's harder to verify that it's completely random. So bunch of DeFi apps and others were like, what if you could do some on-chain randomness as fast as your price feed? And so that's why pretty much it got built, and it was approved recently. And overall the growth has been pretty good. It's been deployed on Blast. I think the best day ever in terms of usage, there was about 30,000 requests for randomness in a single day. So that's like a lot per minute, or almost one every second, or almost. And this has been amazing to see, because it's not something that we thought we were getting like so much traction, but it's very nice. And if you've been using Blast, most of the like lottery gaming stuff, NFT minting, I've been using this, and even now I think it's usage. Blast airdrop happened, usage of all the chain has slowed down a bit, but now we start having quite some traction on Base. For example, Infinex right now are doing their pretty much go-to-market launch, and they give crates to people that deposit, and pretty much they give you rewards. Like inside those crates, you have potential rewards, and they use Pyth entropy to randomly give you prize or not. And I think it has been ranging around 5,000 to 10,000 requests per day on Base just from Infinex. So overall, it's very cool to see so much growth here and there in the use case. And so gaming, it still has to find its way like on chain. Like not everything's like it's not heaven for gaming on chain sometime, but it's cool to see even DeFi app introducing a bit of lottery, a bit of like more like Web2 experiences, as in like raffle, lottery. It's very cool to see. And overall, it's another cool thing about the design also of Pyth entropy is anyone's going to be able to become a service provider. And by that, so I could, for example, start committing hash, and anyone could be able to connect to my service provider, and I would pretty much I would charge for every request, I don't know, 5 cents, 2 cents, 10 cents, pretty much. But what's cool about it is not so much myself becoming a service provider, but it's application becoming their own service provider. And so with this, they could like further customize. They could have, let's say, bigger trust in it while it's completely verifiable on chain. Many people prefer running their own infra, owning it. So big apps could be like those two parties, and then after, as a user of these apps, like, I mean, everything's verifiable on chain, but you do, like, if you use them, you trust them. So I wouldn't be shocked if we see this, and this would mean a very cheap like randomness for protocol.
Okay, thank you so much for clarifying that. And my final question is, what's on the roadmap for you? What are you aiming to achieve in the next 6 months? But also, what are the main objectives that you've set for yourself for the next year?
So here, so I would say with the Peace Express Relay product release today, I think it's going to be a gradual, I mean, we're heads down, and I mean, we have amazing integrators, applications like Ionic, ZeroLand that like help everyone iterate on the product. So very much looking forward to Peace Express Relay getting more and more liquidations happening, more and more value capture for the protocol. And it's just the beginning for Express Relay, because one thing I want to emphasize, it's a very agnostic auction protocol. So it can be expanded to perpetual protocol. It can be even an NFT mint could use Peace Express Relay. So I think the growth almost is going to be, I hope in a year it will be amazing numbers. But if we compare to our price feed growth, it's very much, you need that first big win to kind of get this stamp of approval and people discovering. And they're like, oh, that works, and it works well. So like, I'm expecting kind of a hockey stick growth, whereby maybe for the first 6 months there's not the expected activity, but at some point it's gonna grow infinitely. Entropy, a bit the same status than Peace Express Relay. I mean, its product is, let's say, 7 months old. We start seeing those first big win. So that's very cool to see that. So I think just growing this part, further iterating is super important. Price feeds, I mean, overall it's the price feeds, 500 price feeds available on, I don't know, 65, I'm losing count, but let's say 65 blockchain. This will continue to grow, like more demand on whether it's crypto assets, FX, metals, commodities. So keep growing the catalog. Keep growing the number of distribution channel, meaning new blockchain where you can very much sell the Oracle network or its data. And after, I mean, it's going to be up to the Pyth DAO to decide what's next. So maybe the next big thing is going to be the thing we quickly touched upon earlier that are currently being discussed on the forum. Staking for publisher, potentially used as insurance, and yeah, who knows where the Pythian community is going to bring us, but it's very cool to see. Oh no, and actually, I mean, and the whole goal, the whole point of the Peace Data Association is to support like the growth of the Peace DAO. So one thing that we might see coming soon in the DAO is token fees, for example. How much the Pyth.Network should start charging when you use the price feeds on chain. Till date, real fees, impactful fees have only been implemented on one blockchain out of 65. There is no rush, I feel, because you don't want to hinder growth. But yeah, so I think like more utility to the token. I mean, people are welcome to come and ask for stuff. But yeah, so I think the DAO, and I mean, what we see with other DAO, like Aave, for example, they've been around forever, and they only now start generating lots of revenue. So it took them like 5+ years to have a fully, positive cash flow DAO. So that's the goal of the Peace Data Association, that the DAO grows, the network grows, etc. So yeah.
Thank you so much for having this conversation with me. It was such a pleasure. I've learned so much about Pyth, I finally got the name right at the end of the interview. But again, thank you.
Thank you very much for having me.
Oh, it was amazing.
Thanks
I'm sorry.
No worries.